information presented by our guest speaker, everyone will be on mute during the webinar. Second, please feel free to write in any questions you have using the Q&A tool on the webinar menu. At the end of the webinar, we will take the time to go through these together. Third, there will be polling questions throughout today's webinar. All results are anonymous, and we appreciate your participation. Now, I'd like to introduce Benchmark's Director of Investment, Ronnie Cox. As the head of the investment research team, Ronnie is responsible for managing the investment research and analytics for the Benchmark network. Ronnie has been with Benchmark for 6 years and has worked with participants, employers, plan advisors, and economists. He graduated from the University of California at Santa Barbara with a bachelor's degree in business economics and a minor in technology management. Ronnie holds Series 7 and 66 registrations and earned the Certified Fund Specialist and Chartered Retirement Plan Specialist designations. Thank you for presenting today, Ronnie, and now I'll turn it over to you.
Thank you, Renata, and thanks to everyone that joined the call today. As Renata said, my name is Ronnie Cox. I'm the head of the investment research group here at Benchmark, and today I just wanted to spend some time to look back at what happened in 2016, both in the financial markets as well as the overall economy. From there, I want to give a brief outlook on what we're seeing ahead, and then I want to open it up to any questions that you may have. So let's get started with the financial markets overview, and to kick it off, I wanted to take a poll from our listeners on what they believe the total return of the S&P 500 was in 2016. We'll open up the polling now, so click on your answer in the polling screen. Your options are, was it less than 0%, was it between 0 and 5%, 5 and 10, 10 and 15, or greater than 15%. All right, looks like answers have steadied. So looks like most responders chose between 5 and 10%. The total return of the S&P 500 was in fact 12% last year. The year actually didn't start off well for equities, but by the end of 2016, each of the major indexes, S&P, Dow, NASDAQ, and Russell 2000 posted year-over-year gains, reaching all-time highs during the year. The Dow recorded its best performance since 2013, gaining almost 13.5% from 2015, and it actually closed above 20,000 just yesterday. Stocks weathered several financial crises during the year, including China's economic slowdown and the Brexit vote, but the Russell 2000 proved to be the year's biggest gainer, soaring almost 20% in 2016. Most of the gains in equities happened during the second half of the year as favorable corporate earnings, resurgent oil prices, and accelerating consumer income and spending sent positive signals to the market. Without doubt, the presidential election proved to be a pivot point for stock market as expectations of looser regulation, fiscal stimulus, and tax cuts fueled the market rally. Now into fixed income. Volatility probably best describes the long-term bond market in 2016. Yields on the 10-year treasuries rose for the second straight year as prices fell. The yield on the benchmark 10-year treasury note closed at 2.44%, which is up from its 2.26% yield at the close of 2015. During the early part of the year, bond prices rose as yields sunk below 1.4%. However, as investors saw a strengthening economy, higher inflation, and rising interest rates, a period of bond sales occurred, which peaked during the last quarter when Treasury yields gained almost 0.85%, marking the largest quarterly yield gain since 1994. And high yield was the best performing sector as oil prices rebounded throughout 2016. And lastly, to wrap up on financial markets, I wanted to look at international equities. The big news on the international front was the United Kingdom's referendum vote at the end of June to exit the European Union, now referred to as Brexit. After the vote was announced, Prime Minister David Cameron, an opponent of the push to leave the EU, resigned, with Theresa May becoming the new Prime Minister. Equities took an immediate hit following the news of the vote, but recovered fairly quickly. The value of the pound remains near a 30-year low, and Britain lost its AAA credit rating, increasing the cost of government borrowing. Depending on the negotiations, the UK is expected to leave the EU by the summer of 2019. In other parts of the world, China's economic growth slowed during the year, but later stabilized following further government stimulus. Central banks in Japan and Europe continued to lower interest rates to negative values, intending to motivate more lending and investing in the region. Some other markets to note are Brazil and Russia, that saw strong gains in 2016, and Mexico, whose markets struggled as the trade rhetoric from both the Trump campaign and administration weighed on their markets. Next up is our look at the U.S. economy, and this brings us to our second polling question for the day. How long do you believe we have been in our current economic expansion? Less than 2 years, between 2 and 4 years, between 4 and 6 years, and greater than 6 years. All right, we've still got answers coming in, and we'll close the poll. And it looks like most respondents chose greater than 6 years, and that's correct. December 2016 marked the 90th month of our current economic expansion, making January the 91st. Now, while the current economic expansion has passed beyond 90 months, many people feel the economy has barely recovered at all. Part of this can be seen by the slower, more gradual pace of this expansion compared to previous expansions, as shown by the light blue line in the chart on the right. Economic expansions have generally been getting longer as the service sector, which is a relatively more stable sector of the economy, makes up a higher percentage of GDP than the manufacturing sector. While the true nature of this slower, more gradual recovery is not yet known, some have attributed poor labor force and productivity growth, as well as overregulation that's stifled investment spending. Looking at GDP, the economy maintained a roughly 2% average growth rate through the third quarter of 2016. Economic growth has maintained this pace since 2009. The first quarter GDP rose 0.8%, followed by a 1.4% gain in the second quarter and a 3.5% gain in the third. The increase in the third quarter was primarily driven by personal consumption expenditures, or the value of consumer purchases for goods and services, which increased an average of about 3% through the first 3 quarters of 2016. Gross domestic income, which is a measure of all income earned from the production of goods and services, rose 4.8% in the third quarter compared to a 2.5% increase in the third quarter of 2015. Now on to our next polling question for the day. It's on the unemployment rate. What was the unemployment rate at the end of December 2016? Less than 5%, between 5 and 7%, between 7 and 9, 9 and 11, or greater than 11%. All right. Looks like, again, most answered correctly. So it turns out the unemployment rate at the end of December, as reported by the Bureau of Labor Statistics, was 4.7%. Improvement in the U.S. job market was slow but steady in 2016, with employment growth averaging 180,000 new jobs per month in 2016, compared to an average increase of 229,000 new jobs per month in 2015. As stated, the unemployment rate ended the year at 4.7%, which is lower than the 5% rate at the close of 2015. According to the Bureau of Labor Statistics, there was 7.5 million unemployed people in December 2016, which is down from the 7.9 million people unemployed in December of 2015. The employment participation rate remains essentially flat at 62.7% in 2016 compared to 62.7% in 2015. In 2016, the average work week was 34.3 hours, and average hourly earnings from all non-farm payrolls increased 73 cents to $26, a 2.9% gain over 2015. And lastly, for the economic outlook, I want to take a look at the Consumer Price Index. CPI rose 2.1% in 2016, which is a larger increase than the 0.8% rise in 2014, the 0.7% rise in 2015. This also represents a larger increase than the 1.8% average annual increase we've seen over the last 10 years. While core inflation remained relatively flat throughout 2016, headline inflation slowly ticked up throughout the year. Personal income through November increased 3.5% compared to November 2015, while after-tax income, which is a person's disposable personal income, over the same 12-month period rose 3.7%. Consumer spending, as measured by personal consumption expenditures, climbed 4.2% from November 2015. And for my final comments, just wanted to provide an outlook for the coming months and year. But before we get to that, I want to throw in one last polling question for the day. This polling question does not have a right or wrong answer, but is on how you feel about the outlook for the economy in 2017. Not confident, neutral, confident, or very confident. All right. And it looks like it's pretty evenly split, with half of the respondents saying neutral and the rest split between confident and not confident. So looking ahead, we see a very transitory period ahead of us. Starting with Brexit and the Trump election, there appears to be a continuing transition from globalism towards populism, particularly in Europe. We're looking at European elections this year with the Netherlands, France, and Germany all threatening to overtake the establishment with populist candidates. With the Netherlands elections in March, France's in April and May, and Germany's through October, it'll be an interesting to keep an eye out on these elections throughout the year. With the Trump administration, we also see a potential transition from slow growth economy to a more pro-growth economy, particularly in regards to increased infrastructure spending, which is anticipated to increase inflation, as well as decreased regulation, which is anticipated to increase investment spending. With this increased spending, we're also likely to see a transition away from monetary policy, as the Fed is likely to raise interest rates 2 to 3 times this year, and a transition towards fiscal policy as the government drives more spending. While the pro-growth prospects for 2017 are a positive sign, it's not without risk. With increased political tensions and the potential for the Trump administration to start a trade war with various countries, the level of uncertainty appears to be increasing in 2017. With all that said, I'd like to end my comments on this slide. This slide represents the annual returns of various asset classes for the last 10 years, with the sample asset allocation denoted in the blue blocks with an orange star. While it's difficult for even the most experienced economists and market experts to predict how the markets will behave in the next 6 to 12 months, it's always important to keep in mind a long-term focus for your retirement plan. While the asset allocation displayed in the table has never been the top performing asset class in the last 10 years, it's never been the worst performing either. Keeping an appropriate asset allocation based on your particular circumstances is an important factor to keep in mind with your retirement plan. Now, that wraps up my prepared comments, so we can go ahead and open it up to questions. Renata?
Yeah, thank you, Ronnie. We appreciate you sharing your time and knowledge with everyone here today. We'll now start addressing some of the questions that have been filtering in. And please, as you have more questions, you may submit them using the Q&A tool on the webinar menu. As always, you can reach out to the dedicated service team at ACEC Financial Wellness Center for any plan-specific questions. First question is, can you explain the participation rate and how it affects this economy?
Great question. So the way the Bureau of Labor Statistics calculates the employment participation rate is it looks at the number of eligible working people in the United States, and that's age 16 to 65. And it looks at how many of those eligible workers are either working or looking for jobs. So one thing that's come up in recent news has been about the decline of the labor force participation rate. Some have attributed that decline to people being discouraged from finding employment, while it looks like the data shows it's more of a generational change than anything. As more baby boomers are leaving the labor market, the participation rate is dropping. But for a more formal definition of the labor participation rate, you can always go to the Bureau of Labor Statistics website, which is bls.gov.
Thank you. Next question. How do I know what an appropriate asset allocation is for me?
That's actually a great question. And determining your asset allocation and what's appropriate for you is really a matter of personal circumstance. And so factors that are involved in it include your risk tolerance as well as your time horizon. Now, I would encourage anyone that's interested in trying to determine their own appropriate asset allocation to reach out to the ACEC Financial Wellness Center, as there are licensed representatives available that can help counsel you through what that appropriate asset allocation may be, again, based on your risk tolerance and your time horizon.
Thank you. And last question here. As an investor, what are the effects of rising long-term interest rates?
Great question. That is really a two-part answer. And so with rising interest rates, there's a lot of talk about how that may affect current bond prices because there is an inverse relationship between bond prices and interest rates. So as interest rates go up, bond prices tend to go down. Now that may sound alarming, but that also provides opportunity for newer bonds to be entering the market and for retirement savers to try and capitalize on those that are earning more interest in those new issuances. I want to bring up another point that's related to this. There is, and I'm going to refer back to 2013, there was a period of time where there was a lot of speculation around the Fed raising interest rates and a lot of people wanting to flee out of bond markets in search of a better performing asset class. And this is where it comes back around to your asset allocation, because if you look back over the last 30 years and look at the worst performing years in the bond market, it doesn't compare to the worst performing years in the stock market. And so having an appropriate mix of stocks and bonds in your portfolio, regardless of the current market environment that we're in, I think is most important when focusing on your long-term retirement plan. But excellent question.
All right, so we had a couple questions come in here. So Is much of the drop in unemployment due to the part-time employment or service jobs? And does this affect the economy? And if so, how will this affect how we should invest our money?
Excellent question. Some attribute the drop in unemployment to those who are part-time employed. There's, I think, an interesting field of study now coming out analyzing what's called the gig economy. Everyone's familiar with services like Lyft and Uber and how these essentially part-time employed people are affecting the labor force and how they're affecting economic productivity. So that is, I would say, a factor. I don't want to say that it's the driving factor in the drop in the unemployment rate. If you actually look at, again, this is information that you can find on the Bureau of Labor Statistics website. They actually post job openings or number of available jobs still needed to be filled. And those are still at actually surprisingly high numbers. So even though that our unemployment rate is down at 4.7%, there still are a lot of jobs that need to be filled. So with that said, I don't want to kind of make a comment or advise on how the unemployment rate should affect anyone's investment decisions. I think, again, I want to bring it back to your overall asset allocation, and it really comes down to your particular circumstances. But if you have a financial advisor, of course, reach out to them. And then if you want consultation on your overall asset allocation, particularly in the ACEC Retirement Trust, reach out to the ACEC Financial Wellness Center.
Okay, and last question here I think we have time for. What should we anticipate with the markets and how they will react to the dropping from the TPP and changes with NAFTA that are coming?
Another great question, and this one I think is really difficult to answer. If anyone's or if not everyone's familiar, there is President Trump has already signed an executive order to formally withdraw from the Trans-Pacific Partnership, TPP. That's in effect already, and he's begun the process of trying to renegotiate NAFTA with Canada and Mexico. First, in reference to the TPP, I think there is both sides can be argued, but one seemingly one possible route that the Trump administration might take is, instead of this multilateral trade deal where it's the U.S. Signing this agreement or joining this agreement with several Pacific nations, that the intent is for the U.S. to negotiate unilateral or individual trade agreements. And so while there may be some positive benefits and negative benefits from withdrawing from the TPP and potentially from renegotiating NAFTA, on the flip side of it, there may be some other benefits or potential costs if these trade agreements are negotiated on a country-by-country basis. All that to say, there's not really a consensus on what's going to happen with those trade deals and what's going to come out from that. But it's definitely an interesting area to watch. And again, with that said, that brings me back to your risk tolerance and your asset allocation. So if those are things that concern you in terms of your portfolio, that might be a good trigger for you to look at calling the ACEC Financial Wellness Center, going through a risk tolerance questionnaire, and making sure that you're still appropriately allocated and diversified in your portfolio. But great question.
All right, thank you, Ronnie. That'll conclude this webinar session. Thank you so much for presenting for us today, and thank you, attendees, for your participation. I hope everyone has a wonderful rest of your day, and we look forward to our next webinar series with you. Thank you, and take care.